Hello, I'm Raul Elizalde with a quick take on the markets. Last week, markets were shocked by the news that a company owned by the Dubai government will be defaulting on $3.5 billion of debt, which are coming due in December. Virtually every financial asset went down, except for US Treasuries that were bought for safety. Why the panic? Well, several reasons. For example, the fact that the parent company's debt is estimated to be about $60 billion. Banks exposed to this debt, mostly European, are of course potentially the most affected. Also, this highlights the risks involved in investing in emerging markets, which have experienced massive returns in the last 6 months. But is this really a big problem? Probably not. The global economy is recovering regardless of what happens in Dubai. For example, manufacturing conditions have improved globally, as well as service sector activity. Even more importantly, labor conditions in the United States are improving steadily. So even if this default has some marginal effect on bank lending, the impact on the attitudes of consumers or on the outlook of corporate earnings seems to be quite minimal. Still, markets fell quite a bit in just one day, as if they reacted in panic to a surprising bit of bad news. In fact, this was not a surprise at all, or it shouldn't have been. The possibility of this very default had been discussed at length in recent months. The Economist, for instance, talked about it last September, as well as many periodicals in the Gulf region. And yet, when the announcement came, stocks fell sharply around the world, and rating agencies, as they usually do, downgraded related securities after the news. That is standard operating procedure. Most of the time, Moody's or Standard & Poor's, the largest rating agencies, react after something happens, and as a result, the informational value of the reports is quite minimal for the average investor. This highlights the difficulties of the traditional approach to investing. Investors have long been told that doing homework is the key to success. What this means is that you need to read everything there is to be read about everything you will invest in to come up with your own conclusion, which will be successful only if you do the proper homework. It doesn't quite work like this. Most investors rely on others to do the research. And if analysts from major firms or even rating agencies cannot steer you in the right direction, can you? I doubt it. Chances are rather slim that you alone will find the diamond in the rough or avoid the goat that's being sold to you as a jewel. Examples are too many to count. That is also why consistently successful stock picking is just a myth. Nobody can successfully pick consistent winners any more than anyone can pick winning lottery tickets time after time. A much safer approach, in my opinion, is to invest in baskets of instruments, such as ETFs or index funds. You still have to pick the right sector, and it might take away the big returns that will result from having all your chips on one winner, but being diversified this way will protect you from the disaster that it will be to pick the wrong stock. This prudence might not make for exciting cocktail party conversation, but investing is not supposed to be thrilling. For thrills, an African safari might be a far better choice. For more information, please visit our website www.pathfinancial.net. I'm Raul Elizalde. Thanks for watching.